Here's a tricky question. When you buy an iPhone, who is responsible for the carbon emissions? Is it you because you bought the phone, or Apple's because they made it? Welcome to the confusing world of carbon accounting. The issue of who is responsible for carbon dioxide emissions is critical to determine who has an obligation to make changes to reduce the environmental impact. In this video, we'll be looking at the different definitions of carbon dioxide emissions and what that means for individuals and businesses. Before we look at the iPhone problem, let's start with something simpler. The first class of emissions are called direct energy emissions, which are caused by directly burning fuels. For households, it includes the petrol or diesel combusted in vehicles and gas used for heating or cooking. For businesses and industry, these would include fuels burned in manufacturing processes, fleet vehicles, and heating offices. In business carbon accounting, these are called Scope 1 emissions. Scope 1 emissions are clearly the responsibility of whoever is burning these fuels. You have control over the scale of these emissions because you can invest in more efficient vehicles or heating systems, or indeed you could choose not to burn these fuels at all. What about electricity? The emissions may be occurring hundreds of miles away at a power station, but it's you at the end of the wire demanding that electricity. It makes sense, therefore, that the emissions that arise from electricity use are also your responsibility, even if the emissions are remotely located. These are called indirect energy emissions, or in the business world, Scope 2 emissions. Scope 2 emissions arise from energy that you buy. Most commonly, this is electricity, but you can also purchase heat if connected to a heat network. Some industries purchase steam, heat, or cooling directly for their own processes. Scope 2 emissions are the responsibility of whoever is purchasing the energy. And once again, you have control over the scale of these emissions. This is where carbon accounting remains simple. Every tonne of carbon dioxide ultimately comes from someone's Scope 1 or 2 emissions. If you add these direct and indirect energy emissions across all households, businesses, industries and institutions, it gives exactly the right global total emissions. Under this accounting framework, everyone seems to have a portion of those emissions allocated to them that is their responsibility. It's really very neat and simple. So you'd think that that would be problem solved. All you have to do is make every individual and business responsible for reducing their own direct and indirect energy emissions. There's a problem, however, which brings us back to our initial question. Who is responsible for the emissions from an iPhone? Is it you or is it Apple? On side A, it's the responsibility of the individual. Individuals trigger the demands, and if they don't make the purchase, those emissions wouldn't have occurred. Apple would say they're not making phones for fun, they're just doing it to serve a customer demands. On side B, it's the responsibility of the corporation. They choose how carbon intensive manufacturing is, and they can invest in better manufacturing equipment to reduce the environmental impact. They design the products, control the supply chains, and create the demand via marketing and advertising. And they profit handsomely from selling the phones, so they should hold the responsibility. This debate plays out everywhere, in politics, on social media, and in climate discussions. Here's my personal take, and I'd love to hear your views in the comments. This is a subjective area after all, with no absolute right or wrong. When you purchase something such as an iPhone, there's a transaction, a handshake, where both parties accept some responsibility for the emissions. Responsibility is shared. When you buy an iPhone, you're responsible for triggering the emissions. But Apple is responsible for the amount of emissions because they control the manufacturing process and the supply chain. And the same is true for any product or service that you buy. In order to deal with this issue of shared responsibility, it's often helpful to also include the emissions that come from goods and services when looking at the footprints of individuals, businesses, or nations. These are formally called Scope 3 emissions. At an individual level, Scope 3 includes all the emissions caused by the things you buy and use, even though you didn't burn the fuel yourself. The mining of metals for your laptop, the manufacturing and shipping of your t-shirt, and the farming of your food, all of that is your Scope 3 emissions. If you're a business, Scope 3 covers all emissions that result from your operation. That is to say, anything in the value chain of that company. It includes all the emissions from upstream sources, such as raw materials or components, transporting goods to the factory, and employee travel. It also includes downstream emissions, from using the products you have made, distribution of goods, or disposal and recycling at end of life. That might seem like a lot, but the critical point is this: none of those emissions would have occurred if that business didn't exist. Looking at Scope 3 emissions has both pros and cons. On the plus side, including Scope 3 emissions is helpful because it provides a better assessment of the overall impact compared to just looking at Scope 1 and 2. If you really want to understand your impact on the planet, as an individual or as a business, then you need to include Scope 3. On the downside, including Scope 3 emissions makes carbon accounting extremely complex because it inherently introduces double counting. Your Scope 3 emissions are somebody else's Scope 1 and 2 emissions. The emissions in your t-shirt, for example, that's in your Scope 3 emissions, but in the Scope 1 and 2 emissions of the clothing company. The emissions from the production of your food, that's in your Scope 3 emissions, but it's also included in the emissions of the supermarket, pharma, distribution companies, and agrochemicals manufacturers. This tension between the responsibilities of the individual and the corporation is playing out in debates in our wider cultural landscape and is especially prevalent on social media. Take this tweet from CNN, offering advice on how to reduce your personal carbon footprint. It includes suggesting less meat consumption, flying less, and using more efficient appliances. All good advice, but inadvertently or not, it's a post that puts the responsibility for carbon emissions squarely in the court of the individual consumer. The response was a tweet of a regularly quoted statistic that 100 corporations are responsible for 71% of carbon emissions. This view puts responsibility squarely onto corporations and corporations alone. Scope 3 emissions explain why both these views are incomplete. All the companies quoted in the report are fossil fuel extractors. More than 90% of the calculated carbon emissions were Scope 3 emissions. That is to say, from the use of the extracted fuels by other individuals and businesses. Given that Scope 3 emissions are inherently double counted, it's not actually possible to say that these corporations are solely responsible. There's another way of accounting for carbon emissions which looks at the carbon footprint of a given product. We can use the Scope 1, 2 and 3 emissions methodology to attribute those emissions to the goods being produced. For example, UK crisp manufacturer Walkers calculated the emissions from a bag of crisps, coming out at 75 grams per packet. That's useful. It shows the impact of making that snack. And yet it also highlights this tension between the individual and the corporation. By putting this carbon footprint onto the packaging, it shifts responsibility to the consumer by expecting them to make more environmental purchasing choices. But would they really? Most customers would find the label confusing. How can a 35-gram pack of crisps have 75 grams of carbon? And is it really going to change purchasing behaviour? Most people would choose by their favourite flavour or brand, or even which packaging looks pretty, before they might delve into the details of a carbon footprint. As such, this is an approach that hasn't really taken off. In conclusion, carbon accounting can provide useful information about the impacts of individuals, businesses and nations. But the different definitions of emissions results in inconsistent approaches, and there are tensions that arise because issues of shared responsibility don't fit neatly into a single number. Some things though we can say for certain. Individuals influence demand. Companies shape and have control over supply chains. And governments set the rules of the game. Only when all three take responsibility together can we reduce global emissions.